Welcome, everyone. Thanks for joining us today. We'll go ahead and get started here as we're a little after noon central. I'm Ryan Evans. I'm the communications specialist with the Center for Agricultural Profitability. We're based in the Department of Agricultural Economics here at the University of Nebraska-Lincoln. And our Center for Ag Profitability runs these webinars at this time most weeks, noon central every Thursday. And you can always find an updated schedule as well as recordings of past webinars at our website, which is cap.unl.edu/webinars. And I'll be putting that link in the chat as we go through today, so you can find that, and that will include this recording later on today. And we're glad to have you with us as we take a look at a timely topic as crop insurance decision deadlines are approaching. And today we'll be taking a look at county level crop insurance in Nebraska. And we'll seek to explain how these county-based options like supplemental coverage options and the enhanced coverage option can add value and how they interact with revenue protection, and also when they do not provide protection. So we hope you'll leave with a deeper understanding of how SCO and ECO function, as well as guidance on whether that will fit your operation or the operation of clients you work with. And we're really glad to have presenting with us today Dr. Cory Walters, who is an associate professor in the Department of Agricultural Economics here at UNL. And Cory's research around risk management and decision-making for grain producers is definitely includes a lot of focus on crop insurance. So we are in good hands today with his expertise, and we invite you to take advantage of that during our time with him, and we'll have some time for questions as after his presentation. I think Cory was willing to even take those as we go. So feel free to type any questions that come to mind into the Q&A, and we will work on getting those answered for you. So again, thanks for joining us. And Cory, thanks for presenting. I'll turn it over to you.
Awesome. Thank you, Ryan. Zoom did quit me. Can you hear me?
Yes, we hear you fine.
All right. It tried to kick me out, but it couldn't keep me out. Thank you for the introduction, Ryan. And yes, welcome everyone. We're going to talk about 2026 area yield insurance policies. I'm going to give you the insights that I've discovered as going through these policies and my opinion on them. But at the end of the day, it is your responsibility to understand what you're buying and why, and in that, the value of that. So take what you learn here today and use that in your decision when thinking about purchasing, the ECO or SCO type policies. So let's get into it. Quick outline. We're going to talk about the history of county level parametric policies. I'll use both probably interchangeably. We will talk about just generally how they work. Then we're going to dive into the area that they use to determine the yields. Then we're going to go into the yields, and then we're going to go into correlation. And through all of this, everything is changing. There's a lot of changes to the policies this year. So please keep up to date with your crop insurance agent on what are exactly the current rules and parameters in these policies. So picking up just a few dates here over the past 40 years. In 1994, there was very limited coverage options, and the idea back then was to expand them, and they started with these group risk plans, which were essentially county-based policies, and they relied on NAS data. Then in the late 1990s, revenue products were introduced, and in the 2000 Ag Risk Protection Act, premium subsidies were increased substantially, coverage levels were expanded as well, and then MPCI dominated the insurance market for many years. And now we're at a point where we're swinging back, but in a different way, where we're stacking these area policies, or the thought is, and with an underlying multi-peril policy. So the idea there is that you have some type of area coverage, but then if something really bad happens, you have your multi-peril under that. And then in 2026, the government is encouraging more purchasing of area-based policies by increasing the subsidies. That is literally the point of the premium subsidy, is to get you to become involved in the policy. So what's the basic idea graphically? So in this example, you have an 80% RP coverage on your individual farm, and then you purchase or think about purchasing these two new policies, new premium subsidization levels of 80%, but their policy's been around for a couple of years. This SCO and ECO, if you want to, as well. They're both independent decisions. And so you would buy them on this stacking, the way it looks here, or also these small bands that they offer here. And that's the general gist of it. But what happens in the physical world is these two things may not be anywhere near as nice as they look in the previous graph. In my view, there is a wall here, and we have to figure out how big this wall is. So the only direct connection between both policies on how they trigger claims is via price. Okay, they're the same. But when we go to the yield side, then things start changing dramatically. Over on let me get the little highlight here, the spotlight. Over on the farm side, the individual coverage, farm level yields, you know them, you know what you have, so they are very observable. But when you go over to the area yield policy, you're now going to be inside of an aggregation. It's going to use crop insurance data. It's not observable, and it is going to be different by location, crop, practice, and importantly, the area. And of course, what is observable in this are premiums. You can really see premiums very easily. Go ask your crop insurance agent. They will tell you the premiums. And inside the premiums, inside our thought process, we oftentimes want to minimize the premium. This may be a case where perhaps you don't, okay, or have a very well thought out philosophy, idea, strategy of how you're going to, operate with this choice of policies now. So let's get into the area. We're going to talk a lot about Colfax County. This is Colfax County irrigated corn, and this is their area. You can see it on the RMA documents. So as we'd expect, if you're a irrigated producer in Colfax County, your area is literally Colfax County. Okay, very, very, very straightforward. But if you move west and you're in Scotts Bluff, your area now includes Banner County. So the area is not always the county. Okay? And these are both non-irrigated corn. Okay? But if we want to go back over to Colfax County and decide we're thinking about raising some grain sorghum, which there's a few acres of grain sorghum, your area now is a 25 county region. Okay, it is substantially different than if you're in corn production or soybean production in Colfax County. Now, there's likely a lot of good reasons for this. I think the underlying function here is literally acreage. And so that when there's not a lot of acres, to get a policy, to get a rate, to get the evidence of what the risk is, they are expanding the number of counties inside of that area. So for grain sorghum, it's drastically large in Colfax County. Okay, again, very few acres in Colfax County, but if you're thinking about these policies, and you have a particular crop, you need to go find out what that production area is. But it doesn't necessarily stop there. For irrigated grain sorghum in Colfax County, we're now up to like a 35 county area that includes 5 states. And my question then would be, at what point does the area get so large that it's potentially not a good idea to even have a policy available? Okay, and remind you of all the issues with GRP back in the day. It was not a very popular policy, so I'm not quite understanding how 35 states or 35 counties makes it any more enticing. Okay? Let's go down into where there's a little more grain sorghum, it's a little more popular. Let's go to Jefferson County. And so if you're a grain sorghum producer in Jefferson County, you're also that area is going to also include Republic County, Kansas. And these two counties are catty corner. So that brings in some interesting thoughts on how you're going to operate with SCO or ECO in Jefferson County. And the obvious one is, well, perhaps I want to participate in this in Jefferson County, and I want my brothers in Kansas, in Republic County, Kansas, particularly, to have some type of massive issue, wind, hail, that I am not going to be subject to here in Jefferson. I'll get a payment and I'll have good yields. So some weird processes start coming out of this. And over here for Thayer, you're also going to use Republic, and if you're engaged, it's going to use Marshall. So these things are changing. They're different. They're not always just one county. So please ask your crop insurance agent of what counties are included and get an idea of what they mean. Okay, what does that mean? How close are they? Are they catty corner? These two policies, it's the same policy, SCO, ECO, but they're going to act completely different from a 25 county area to a 2 county area. Okay, they're going to be different, even down to a 1 county area. My view is you keep blowing up the counties, the relationship, we're going to come to the correlation here soon, starts eroding. Okay, so that the value proposition appears to start eroding, because I don't know where the acres are here in these counties for grain sorghum. So I don't even know where the yields are coming from. I don't know if it's weighted down here, weighted up here. I don't know. I'm not sure. One more on these. You got Clay County, so it's kind of the same area here, and it uses all the counties around it. Okay, so it's a little bit larger area. So these things move fairly robustly between counties that are even touching each other. So keep an eye on that, please. Let's move over to yields. They are updated yearly. Of course, they rely on RMA data, and there are changes year over year. And so let's jump into those year over year changes. Here's a map of Nebraska. This is non-irrigated corn yield change year over year. So any of these gray counties here, same yield as last year. Okay, and some counties are going to have big changes here. So Platte County went up by 19%, and we're going to talk about Platte County here in detail here in a few minutes. Other changes, Cherry County went up by 18%. Some counties over here went down quite a bit. And what some of these changes are happening is they're actually switching out irrigated and non-irrigated, where they're not the same yield anymore, or maybe bringing them back together, which is an interesting part of these area-based policies, which I will be discussing more. So across the board, kind of what you'd expect. A lot of counties had small changes, and I would attribute that to technological changes in corn production, where you're growing more bushels, so it's being reflected here in those yields. Irrigated corn, completely different. So you want to ask for both to find out what's changing, and of course you want these things to be changing with your farm yields. If your farm yields are going up and the county yield is constantly staying flat, then that is eroding the usefulness of the program. Okay, I only have year over year changes here, but you can look up the multi-year yields to see how have they been progressing, and are they moving with you on your farm. So let's go over to soybeans. Similar type thing. I zoomed in on these a little more so you can't see it, but the gray, you can't see the numbers, but the gray is no change, and then the darker ones are negatives, and then the lighter blues and darker blues are higher positives. So similar here as well for non-irrigated down this, or sorry, irrigated over here, non-irrigated here. All right, let's dive into non-irrigated and irrigated yield, same crop, same county. And first thing is, if there's a non-irrigated MPCI policy, then one would assume there would be a standalone county level policy. And this is not always the case. So you want to check the 2026 area parameters to see how that is. And this is from a couple years ago, but these counties that are highlighted here have actually the same yields for irrigated and non-irrigated. Okay, the same yields for irrigated and non-irrigated, and that's the same over here for soybeans. The highlighted counties here in green, they have the same yields for irrigated and non-irrigated. And that is going to be very important. And Platte County here gets the Gold Star Award with the Nebraska red outline because it is a fascinating county. And let's get to why that is. So, Platte County and Colfax County. Let's start with Colfax County. Corn, irrigated, non-irrigated yields. First thing to notice, they are exactly the same between both irrigated and non-irrigated, and it has been that way for at least 5 years. And I think we went back into the data further, we would find it's been one yield all many years, and that yield is a non-irrigated yield. It's operating like a non-irrigated yield. For their brothers to the west, directly to the west, they are in Platte County. They are under a completely different regime with a lot more variability. Platte County has the same yields in a couple years here in the yellow, and those yields, as you see, are substantially higher. Those are irrigated yields, okay? And they did that in 2026. But there was 2 years in here where they broke out the yields between irrigated and non-irrigated, okay? They broke out the yields between irrigated and non-irrigated. So if you're hanging out over here in Platte County, you don't know what you're getting, okay? You don't know what 2027 is going to bring. Am I going to be a blended yield? Am I going to be separate? What's going to happen here? And if I'm a non-irrigated producer, then I would be wondering, why am I using these irrigated yields when I also have an underlying MPCI policy with non-irrigated parameters? Another fun reason why this is important is if you happen to be just across the border in Colfax County in 2022 and 2023, you would have had really nice payments from the county level policies in both of these years. And if you see where I'm going, if you had irrigation in Colfax County in both of these years, you were getting a payment. Okay, you were getting a payment. And so then you're really happy. But if you happen to be just across the county line in Platte County, it is a completely different outcome. And that is a little bit of my angst with this program, is it is wildly different by county, okay, by county. You have to know what's going on in the county to devise your plan if you're going to participate in these, of how you're going to work in it. Let's switch gears a little bit. Let's go county versus farm yields. This is very important that the aggregation changes the shape of the yield distribution, and you are going to be sampling underneath whatever yield distribution you're in. So in this case here, and I don't have a farm here, but I have the Norholden plots out in Scotts Bluff, okay, and I have Scotts Bluff County yields. So let's walk through this. So this is the yield distribution for those plots, okay, and it's really, really, really wide. It actually hit zero, I think, twice in the past 100 or 80 years, okay? But you don't know when you're going to be raising corn on those plots, what yield you're going to get. You're sampling from this really wide distribution, okay? A farm is likely not going to be as wide of distribution of this, but it definitely is it will be less, but it will be greater dispersion than the county. And so this is the same county that this field, this plot is operating in. This is Scotts Bluff County distribution, right? And why that is important is when you select an area policy, you are now sampling out of the area yield distribution, a distribution that we don't entirely know the shape of. But in the case of Scotts Bluff, we do know the shape of it. And we can see right here with this green line that if you knock off about 5% off that yield, which is represented by the green line, you can see the area underneath to the left of that green line. That will give you the probability of a claim. And that is going to be completely different for the county yield versus the farm yield. So when you're buying the county policies, you need to think about what is that county yield distribution. Okay, what is that county yield distribution? And there's going to be places where the farm and the county could be really nice. They could be very close. And there's going to be places where they're going to be really wildly different. Okay? And let's go a little further into the same concept. I'm going to put the CDF up here for a very important reason. And so I'm going to knock off 5% off of yields. I'm going to go up to the chance of going below, 95% of the county yield. And that puts me somewhere, let's just call it a solid 25% chance. Okay, 25% chance. But if I were to go to the farm and I go all the way up till I hit the farm yield and somewhere in here and I move over, that's substantially higher. Okay, substantially higher. And the point here is those SCO, ECO premiums for the same coverage bands are cheaper for a reason. Because your chances of the yields going lower are lower for the county than they are for the farm. Let's talk, and I'll come back to that here on the premiums in a couple slides. Let's talk a little bit about correlation and where this is where you don't want to buy, the horse race ticket and take it to your banker and say, look, I have protection. Okay, I have protection. This is important. So think of the farm yield here, and in this case, the farm yield declines. And in this world of a correlation of 0.48, the county yield can be anywhere around here. You may have a county yield that also declines, but you may have a county yield that is higher, that would kick you out of a payment. Okay, to kick you out of a payment. So you have a farm yield loss, but the county has a good year. Okay, that's very real here. All right. This is some farms in a group of farms together over time and the RMA county yield for a particular county. And the correlation here is 0.62, which is weak, but it's okay. And you can see that the farm yield and the RMA yield generally followed each other pretty good. But the one that's really going to aggravate people is this guy here in 2023, where the farm yield in this sample, the farm yields dropped down, but the county yield actually went up. Okay, went up. So you have a problem on your farm, but the county has nothing. So there's no payment. Okay, in this case, from yields. But I think there's a little more to say with correlation. And that has to do with farm size and the size of the county. So our hunch is that the correlation will increase with larger farms that are distributed around the county. And the best one I've seen is a 0.9. And this is a farm that is in almost every soil type around a county. So if that farm has a yield loss, okay, it's nearly guaranteed that the county is going to have a yield loss. Okay, so they can view the county level policies different than someone, let's go over here to a 0.28. And I'm thinking of a smaller farm in a large county, okay, that their production's in one small area in that county, and they have a yield loss. You don't know what the county's going to have because it has to take in all that other area. And when I say county here, I mean area. And what if this is grain sorghum and you're in Clay County and you have 6 or 7 other counties all the way around that thing, right? You're going to have to find out what happens in all that other area. And that correlation, as that area grows, is likely going down. Okay. So there's a much higher chance of a bad outcome with the county level policy, area level policies, and a small farm. So I'd encourage people to be very careful with this because of the correlation. Okay, because of the correlation. Let's switch to premiums. What do premiums tell us? Well, the underlying ideas are going to tell us about the associated risk. And here's an example of that, and maybe one way to deal with it. Think about it. This is the farmer paid premium for Colfax County, 2026. I think we're non-irrigated in this case. So if you're, what I did here is I'm going to go to the fully loaded, multi-peril policy, and I'm going RP 85%. We're at enterprise units here, and we could debate what unit structure we should have, but we'll go enterprise units. So you're going to pay roughly around 22 bucks an acre. And of course, with the financial conditions and the need to save dollars, you may say, well, maybe I'll drop my RP to 75%, keep my enterprise units, and perhaps buy SCO, because that's going to take me up to this 86% level. It's going to be very similar to the 85 at the RP. And in that case, it's going to be a little over 12.5 bucks an acre. So the way to think about that is this difference here of nearly $9.50 an acre, is that worth dealing with the correlation and the associated financial risk with that? Again, if your correlation is low and you have farm finances are, I don't want to say shaky or thin, but they're not really, really robust, really stellar. This may be tough to swallow because you think you have protection because your insurance documents are going to tell you that with SCO you have this protection, but you are sampling from a fundamentally different yield distribution. Okay, fundamentally different yield distribution. So you have to ask: is the savings, this $9.50, is it worth it to move over to the county yield? And there can be plenty of cases where that is. And there's going to be cases where that is not a good idea. But thinking deeply about it like this will help illuminate which way you should be going. So here are my points. Area-based policies. They add complexity to the farm risk management strategy. Farm size needs to be taken into account. Farm yield to county yield correlation needs to be taken into account. The financial position needs to be taken into account. And it is getting more difficult because they are becoming cheaper with the premium subsidization. So it's going to be harder to turn down. Know what you're buying. Your crop insurance agent can help you with this. You can figure out a rough back of the envelope relation to what your farm yield is to the county. You need to know what that is. And they're gonna move a lot. And in some of these cases, perhaps there's no relation. Okay, there's zero. That doesn't mean actually maybe you shouldn't buy it, but you could think differently about buying it. And think of irrigated corn in Colfax County. Man, people are buying that and they're happy to get a drought payment under irrigation, right? Because they're not going to have the loss, but the non-irrigated side will, and they're going to trigger. Okay, they're going to trigger. So that's intriguing. And then the other one is non-irrigated corn in Platte County, complete opposite, right? They're going to buy it. If they do buy it, they got to be very careful because that yield is now coming from an irrigated side. So it is not going to move the same when there's a drought. Okay, that's what it looks like to me. But that doesn't make it all bad. We've been talking a lot about yields. Perhaps there's a strategy with prices. And for the Colfax County in 22-23, there were payments on prices. And perhaps that strategy is buy when there's profitability as price will likely go down due to additional supply. Okay, due to additional supply. So perhaps that's a real solid strategy that could work very well over time. And again, you need high prices that are incentivizing, more acres. Okay, more acres. I would be reluctant to add the liability from the county policies into the risk management strategy because it depends on the county yield. And I don't know your correlation from the farm to the county. Okay, and I don't know if that yield under that practice actually reflects the practice you're producing. Okay, so I would be reluctant there to include it into, telling your banker, I have this amount of protection. Okay, I have this amount of protection. That still doesn't mean you shouldn't buy it, but you should think deeply about what does that really mean. Okay, and maybe there are ways if you go through this and figure out the correlation's high, I'm in good financial position, and the area is real small. It's my county I'm in. That's all it is. Perhaps then there's a reason to buy for a risk management strategy. These things are so cheap, maybe you just buy the darn thing as a lottery ticket. Buy it, forget about it, and do not change your underlying multi-peril policy. Okay, do not change your underlying multi-peril policy. Know what you're buying and the reasons. Know it better than anyone else. Right? Don't fall prey to you have this much of liability. There's all this protection running around. You need to know where those yields are coming from in the distributions, the general idea of those distributions of which you're sampling from. And my other angst with area-based policies is they lack transparency and consistency. I don't know where the yields come from. I don't know whether there's mechanisms that kick out certain yields from that yield calculation for the county. That stuff is all private information. But I can see it on my individual multi-peril side. It's really clear. That again, it's not making it bad. It's just questions start coming. I also don't like the unexpected changes. I don't like that Platte County, what's happening with Platte County. That's concerning. And if we can't be consistent, then it's really hard to think about what's the value of the program when the rules of the game keep changing. I'd like to thank you for coming. Please reach out to me if you got questions. I'm happy to answer any questions, take comments. These county level policies are tough. They're not easy. Please think deeply about them. Talk to your crop insurance agent. There's a lot of reasons to buy them. Just don't buy them for the wrong reason. And with that, I'm happy to take any questions.
Awesome. Thank you, Cory. If you don't mind leaving that slide up on the screen while we answer these, we've got a lot of people on with us today. So just in case we run out of time before we can answer everybody's questions, we do have quite a bit of time here, but just in case, there's Cory's email address again, so you can feel free to reach out to him if you don't get your question answered or if something comes to mind after this. So Cory, first question for you is about specifically hybrid seed corn policies. Says that the multi-peril policy for hybrid seed corn doesn't require proven production. So with no county RMA data available for ECO on that, what do they use for yield at the county level on seed corn? And then what are your thoughts on ECO added to a hybrid seed corn policy?
Oh, that's a fantastic question. That is something I have not thought about at all, so I cannot give a good answer on that. I'd have to dig into the parameters of what is in that policy. So I can't even begin to give a reasonable answer at this point. But if you want to reach out to me, I am happy to engage to see what we can uncover on that.
Great, thank you. Next question is, which categories have the highest subsidies?
Which category? So we're talking contracts here, I would think. I would encourage you not to think about the subsidy level, but to think about what you're paying here. the and if you do want to talk about subsidies, I would think about subsidies as dollars per acre instead of the percent subsidy. And the reason for that is the premiums can rise quicker than the decline in the subsidy percent, meaning you're getting more subsidy dollars per acre. Okay, more subsidy dollars per acre. Um, Thinking this one here with the SCO, and I want to say that SCO was like $5 or $6 an acre or something, pretty small.
Great. Thank you, Cory. Someone is wondering where you can find maps or the information showing what geography that your individual area policy would include.
Oh yeah. So we made the maps here, but if you ask your crop insurance agent, they can see that in the actuarial documents. Or you could go to the actuarial documents yourself. They're online on the RMA website, and it will give the list of the counties under there for each crop in practice. But I'd ask your agent. They should be able to see it pretty quickly.
Next question asks, can I insure a hemp crop?
I don't that I have no idea off the top of my head. I'd have to look into that. I do not know what the federal rules are on all of that and where that policy is. I'm sure there's some crop insurance agents on here that would have a very quick answer to that. I do not know.
All right, thank you. Do you have an example of how these work? That's what it says. Chad, we might need more clarification. I don't know, Cory.
Mm. Well, yeah, they're fairly straightforward. Um, so if your individual coverage, your guarantee drops, 20%, then you're going to get an indemnity payment. Okay, and that's going to use your individual yields and your APH, and that's fairly straightforward. We're well into that regime, understanding that the area policies will work similar. They're just going to use the area yield and the same price, and so they'll act the exact same way. But you're just insuring, these bands here. I think I have it here on ECO, and this one I did 86 up to 95. That's the max. It'll insure that band. Okay, and then under SCO, you're gonna insure, in this case, 80 to 86, because it's gonna piggyback off this individual coverage side. So if you're at 75% coverage, it's gonna go up to 86, which is gonna pick up that difference there. And that's effectively how they work.
How about county yields? Where can those be found?
Oh yeah, that's in the exact same RMA documents that I was referring to earlier. And your agent should be able to get those very efficiently and effectively as well. Yeah.
Okay, and then somebody asking for maybe clarification, does an increase in area yield offset a price decrease? Is that correct?
Yeah. Oh, that's a great question. So essentially, are you paying a different price for Colfax corn irrigated when it's just Colfax versus the whole entire area? That is worthy of more time to dive into that. I do not know the answer to that. I do not know, but we could look up the risk rates for these things and see if it's, if Colfax County non-irrigated is similar to, let's say, Jefferson with just one other county. But I don't know the production risk differences between the both. But one could imagine perhaps it could go maybe either way. I'm not entirely sure because there's also acres involved.
This one's maybe just more of a question for you as an industry watcher. What's going on with emails? Somebody's seeing a lot of emails about self-insurance policies showing up.
Oh, yeah. So there's we're 26 years now into the federal crop insurance regime. There's, as we highlighted here, maybe there's some interesting facets to the program, and perhaps there's a different way to insure your farm that uses some private products that would improve upon the transparency and the consistency.
Cool. Thank you. Um, let's see. Somebody thought they read somewhere that USDA is treating popcorn as corn. Is that true? And do you know if that applies to crop insurance as well?
Well, I've not heard that one. There is still a standalone crop insurance policy for popcorn. So I would say right now, no, that's not true.
Do you have a best guess on how many years they use for calculating county data and if they use yield options or not?
Oh boy. So that is also a good question. Let's go back here to the yields. So I always kind of thought the same thing. You know, how much would these things be changing? If you got a long yield history and you're just adding another year, you know, it's not going to weight a lot, so it's not going to move it a lot. These are typically not moving too much unless you got something like this Platte County where it was this non-blended yield in 2025, and then they went back to a blended yield between irrigated and non-irrigated. I'd say most of it is moving with technology to some degree. Seems reasonable. So they must be using some pretty long history, and that history can get quite interesting because it's going to consist of NAS data and RMA data. So somehow they made that work.
Cool. This is more of a comment, but we have written that I think these ECO, SEO really bring some value, a bit of a larger, smaller version on PRF coverage in a way. In Western Nebraska and Kansas, it could be really a benefit over time. These products could. You will not collect every year, but the likelihood of an indemnity over time is pretty substantial.
Yes, that is a wonderful view. That in that view, you are not treating it as you're substituting out your multi-peril down for a cheaper cost. Where's that guy at? Where did I put it? Right here. So you're not making a subsequent change to your underlying multi-peril, trying to get, you know, a similar amount of dollars protected for a cheaper premium, not knowing that you're including this county yield. In that case, that is a solid plan. That the only way I can see improving on that is following economics, and when the corn price is high in the spring relative to cost production, there's a much higher chance of a lower fall price because farmers are going to respond with supply. Okay, of course we got to go through droughts, you know, the weather for that year and all that stuff. But solid plan, would not have any problems with that at all. But that is more of the more leaning on the side of the lottery ticket, not a fundamental risk management plan that you can take to the bank and say, I got this protection. It's somewhere in between there.
Thank you. A few minutes ago, there was a question about, do you have an example of how this works? And thanks, Chad, for clarifying. You asked if there was actually like a real life example. So maybe he could reach out to you to walk through something.
Totally. Absolutely. Please. Yes.
Perfect. What do you think of the idea that you could make a profit on this insurance, since USDA and FSA pay administrative costs and a large percentage of the losses? Do you have any thoughts on that?
Yeah. So that yes. The long run theory is that by just purchasing it and staying in it, you can make money off of it, because you're only paying a portion, a small percent, 20% of the risk premium, right? That premium you see for the area policies, that is just the risk premium. That's what you pay for. So you're only paying 20% of that. So you should see a return. Where that gets a little wonky is when if you're in Platte County and they start switching things around where they're blending yields, non-blending yields, different things happening. That's a little weird. So yes, I still think it's a solid strategy, and I think you can do better with it if you follow economic incentives and profitability.
And then beyond Platte and Colfax counties here in Nebraska, have you seen whether this irrigated and non-irrigated issue plays out in other counties? Ask specifically counties outside of Nebraska as well.
Oh, yes, undoubtedly. Actually, I think I have that map. Let me go to that guy right here. Yeah. So so the same thing is happening in other locations. So what this is here is these are all, and this is old. The RMA is changing it too quickly, like Platte County. Um, so these counties here that are green, they have one risk rate for irrigated and non-irrigated, okay? But they have separate yields for irrigated and non-irrigated, okay? They have separate yields for irrigated and non-irrigated. But one risk rate, the same risk rate on the multi-peril side between irrigated and non-irrigated. And that makes sense as you move into Iowa, rainfall's increasing, the yield growth from irrigation changes, right? It's not anything like out here in Nebraska, where precipitation is usually the limiting factor.
Thank you. Is it better for me to purchase these plans if my APHs are below, above, or about the same as the county expected yields, or does my individual yields compare matter at all?
Yeah, no, they do. So I did have a little spot on this, that if let's just use a wild case. Let's say your county yield is 100 and your farm yield is 200. 5% off of the 100, you can see, you got 5 bushels, okay? And off the 200 off your farm, 5% is 10 bushels. So for each 5% increment, you're going to get double the bushels on one side. But in the SCO calculation or the area calculation, they adjust for some of that with the using your APH to find that band, that liability band that gets applied over to the county. So it's not. I think it matters in one direction, but I think the bigger picture is the correlation. Is that I think the yields are important, but they're not as important. The yield differential between them is important, but not as important as the correlation between it, because you can still have wild yield differences between your farm and a county and have a really bad correlation because you're farming, a small area in a very large county. Okay, in a very large county. So that's why I didn't talk about it.
That's good because the next question asks, would looking at historical county yield data help you in making decisions on ECO and SCO?
Yeah, yes, that does help. And let's go to those guys. Right here. So first thing is you never want to make a decision on last year's outcomes. Okay, it's not last year's outcome. Look at a long run of that thing. And if you want to do that, pick out the years that the price triggered it. Okay, that the price triggered that thing, and you better use a lot of years. Okay, 20 plus. And if you're going to start using fewer years, you need to understand that there's observations that you've just not seen yet that are going to put outcomes to this thing. Maybe the best one is here we go. Is the Scottsbluff County yield distribution and then this plot data. If I use 5 years of data in there and I looked at the same thing, I'd see a completely different answer because I'm missing information about the shape of the yield distribution. You have to get enough years to get the shape of the yield distribution. And if you don't do that, you are making a grave mistake in understanding the shape of the yield distribution. And oftentimes all you need is just one really bad yield down in the tail, to put the 2012 in there or something, or a massive hailstorm or windstorm, something. Get something down there and know that there's other things around there that just have not been observed yet, because risk is exactly that, rare.
Someone asking if where can we find which counties receive payments the last few years?
Yeah, that is on the RMA summary of data. That's deep inside of that. So that is there. Your agent, they might be able to access that. It would take a little finagling, but it's possible.
I'll kind of tie two questions, comments together here. Any advice for people who may understandably be finding this to be a super complicated process? And then, especially if or alternatively, any advice for somebody going into their first year of farming, where to start with crop insurance?
Yeah, first year starting, um, you keep reading as much as possible. Um, know who you're talking to. Is it a commission-based person or not? Um, own your decisions. It's your operation. You own it. You learn it. You enact it. It's your strategy. These things may look complicated, but I think you can boil it down to a few things. If your farm is fairly small in acreage relative to the county, you're going to have a really bad correlation. And that that alone right there, as far as the area policies being a risk management strategy, is probably pretty slim. Probably pretty slim. So if you're going to buy it, you're buying it just to have exposure to the game that of the tools that are being offered to us, and you're not thinking about telling your bank, hey, I got this protection from this thing. You're more telling your bank, like, I have an option here, and I may claim on it. That would be my take. I think you can boil it down to a few small things.
Awesome. And then kind of a good meta question to wrap up on, as it's the last one we have in the Q&A panel right now. Why does the government subsidize crop insurance?
Okay, well, so the stated objective is to entice participation, right? To entice participation. So that's the idea, is they want you to participate in it, and so they're going to subsidize the premiums to get you to participate in it, and that comes with a lot of other things. First one is when you subsidize and you get a lot of people participate, well then you get a good book of risks in there, and otherwise, maybe if you don't subsidize it and all the adverse selection people buy it, well, maybe they get all the bad risks that they don't want. So there's some actuarial stuff that will happen there. And perhaps maybe in that same vein is why are we subsidizing it more? Why are we getting more dollars, and why aren't we starting to back off from this and self-insure through strategic means ourselves? I don't know. There's a lot of forces in insurance that they got a lot of weight behind them. So there's a lot of things happening. And as a farmer, I would try to learn very carefully what these policies are doing and why, and come up with some simple heuristics about when you're going to participate and not, and go with that. And when you realize there's more information, learn it. And if it changes strategy, change your strategy.
All right. Well, that's all the questions that I see for right now. Again, Cory, if you want to slide to the end there, we'll put your contact info back up if people want to reach out to you. We do have one more come in. I'll get to that here in a second. I do want to thank everybody for attending today. And when you close out, you'll be presented with a really short survey. If you don't mind just taking 30 seconds to respond to that, we really do value your feedback on what you thought of today's webinar, and then any ideas you might have for future topics we could cover here at the Center for Agricultural Profitability. And I put the address in the chat for the location for this recording. It will be on our page later today. And there you can also sign up for future webinars on our schedule. So Cory, next one that came in says SCO is basically subsidized Art County. Any thoughts to buying this and rolling with PLC?
Yeah, I've not. That's a good question. I've not updated the parameters on PLC to see where that would come out. And I'm assuming you got good base acres relative to planted, but that's an intriguing question that's worthy of some time.
Good one. Is this insurance considered an asset when figuring lending ratios?
Well, we're talking. If I go straight to the area policies, well, it's a cost to begin with. You're going to pay a premium no matter what. Then you're down to whether there's a payment or not. I don't think I would include it as an asset, as more of a exposure to a financial instrument that may or may not pay me, that is somewhat linked to my primary business of production ag. And if you embed that into your business structure, knowing that I'm just have this exposure, and I'm not thinking about it's going to save me if something bad happens, because the county may not have a problem. Maybe that would be the right way to think about that. I'd have to give that some more thought, but I probably wouldn't put it down as an asset, more as exposure off the top of my head. It's a good question.
We probably don't know if the lender would consider SCO as an asset necessarily.
Yeah, I not even the lender. I'd be a little cautious myself as a farmer, telling the lender I have this protection, this amount of protection when you're sampling from that yield distribution of the county. But if it's on price, if you want to focus on price, then perhaps there's something there. It's just today, going into 2026, the prices are depressed enough that people are not thinking about expanding acreage, which would thereby drive prices down, more likely down in the fall. They can still go down. There's plenty of reasons. There's plenty of risks out there, market risk. So it appears less likely on a price play this year than otherwise. But I could easily be wrong on that, and that is just completely my opinion. I'm just trying to give you a strategy of how to participate in these things. There's really no wrong way. It's full of opinions, but just know what you're buying and why you're buying it. And the one I would be reluctant to do is be changing my multi-peril.
Yeah, and a comment came in, not an asset or a cash flow item. It's not a guarantee as a county-based coverage, not like multi-peril or MPCI guarantees. So
Yeah, that's exactly right. Yeah.
cool. All right. Well, we have almost reached the end of our time. So again, thanks everybody so much for attending today. Thanks again to Dr. Cory Walters. He's an associate professor in agricultural economics here at the University of Nebraska-Lincoln. And you can find this recording later today on our Center for Agricultural Profitability's website at cap.unl.edu. We hope you have a great afternoon. Thanks again for joining us. And Cory, thanks very much for the great presentation and answering so many questions.
Thank you, Ryan. Appreciate everyone.
Take care.